Hello, my name is Ben MacNevin from Montgomery Investment Management, and welcome to another Video Insights. Many companies have engaged in capital management this reporting season, and we have already seen companies announce capital returns to investors by way of special dividends or share buybacks. So for today, I would like to discuss the role capital management plays in the efficient allocation of capital between companies and shareholders to maximise returns. Effectively, capital management is a two-way street. While some investors may be pleased that their income has increased this year due to excess distributions, it's important to understand if these companies will have sufficient access to additional capital later if growth opportunities present. Let's explore this concept with a simple example. Let's say you have $100 which you have invested in a company for a desired return of 10%. Let's say that after the first year, management have earned $10 with that investment. What should management do with that $10? Well, if the manager has identified opportunities to grow and can deploy this incremental capital at returns greater than you could possibly generate elsewhere, then we would have a preference for management to reinvest the proceeds rather than paying them out as dividends. But if there are limited opportunities in the market, then should the $10 of profit be returned to the shareholder? Well, efficient market theory would say yes. The argument is that the shareholder would be able to take the $10 and reallocate it in the market for the desired rate of return. But while this sounds logical in theory, it may not be achievable in practice because it assumes that opportunities to grow the business occur on a consistent basis. And it also assumes that managers can tap capital markets with minimal friction. So let's say that the manager cannot deploy the $10 of earnings today. Theory states that the management should give back the $10 to shareholders until an opportunity presents, at which time the manager can freely tap the markets and take the capital back. But transactions in the real world are not frictionless. While a growth opportunity may present in the coming years, there is a real risk that the cost of capital required to pursue this opportunity could be greater if the company needs to tap financial markets rather than drawing on retained earnings. In this sense, a bird in the hand can be worth two in the bush. At Montgomery Investment Management, we assess the effectiveness of a company's capital management practices by considering their long-term prospects. If a company can justify the need to hold onto their capital because there are compelling opportunities on the horizon, then we can be comfortable that earnings are being retained. Thank you for joining us again. Please follow us on Facebook and Twitter.